Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
Good morning, everybody. Welcome to this Tuesday edition of Benzinga's Pre-Market Prep. Spencer Israel here with Dennis Dick. Joel will be back with us tomorrow. Got a cool show for us today, folks. We got earnings. Obviously, the banks take center stage. JP Morgan, Wells Fargo also has Delta this morning. United Health. We'll talk about those. We'll talk about the pod stocks. A convenient day to talk about pod stocks for us because I am at the Benzinga Academy's Capital Conference here in Miami Beach. I'm talking to you from my hotel balcony, so I hope it's not too loud for you in the background there, but we're going to talk about Canopy Growth and Tilray and the pod stocks that just keep on rallying, and they are hot. So we're going to talk about that. We're going to talk about SSYS, Play raised their guidance, some ratings as well, and two guests on the docket today. Jeff Hirsch, editor-in-chief of the Stock Traders Almanac, and Nick Chahine will join us at 8:35, just at 8:15. Dennis, how's it going up in cold Canada?
Yeah, I know. Well, you look like you're cold there too. You're in Florida, but you're shivering there. What's going on?
Well, it's like 55 degrees. I mean, it's still early here, but it's like 55, so it is it's burr down here. But I can see the ocean from my balcony right now.
Can you turn the camera on? We want to see the ocean. Try it.
See the ocean. Okay.
Yeah, show us the ocean.
All right,
here we go. Let's see what Spencer Israel. Look at this guy just lives the dream, man. I mean, he's sitting there looking out at the ocean. Probably watched the sunrise this morning. Just living the dream.
What can I say, Dennis?
I see the ocean. The only place I see that is on TV.
He's on TV.
And right? I just saw it right now, so I'm pretty excited. That was pretty nice.
Yeah. All right. Well, I'm glad I could do that for you.
What's up?
Right. Not much, man. Not much. I was just looking at my my pre-market movers, and I want to talk. I guess we'll start with a stock, and it's not in the news, but you were tweeting about it yesterday. The SSYS. And it got the old fast money mention there, and there's no.
That's the best fast money mention I think we've ever seen. I don't know who the guest was on the show. It was an analyst, ARK Investments or something. What did you have her background? Holy cow! Next time she mentions something on fast money, I'm gonna buy it.
Yeah, wait. Let's see if who was it? It was Dan Nathan said so.
Well, Dan Nathan liked it, but Dan Nathan isn't moving it up 7% this morning. Right. It was the analyst that liked the stock. And I don't know what she said. I actually missed the clip, but my one buddy was like, "What's going on with Stratasys?" He's like, "Oh, they just mentioned it on fast money," and I missed the clip. I should have rewatched it, but SSYS at one point was up 10% because it got the positive mention on CNBC. I was like, "Wow!" So, anyways, I did short it. I shorted early though. It kept going up afterwards. I didn't think it was going to go much higher than 2075, and I shorted there, and it was 2150 in my face. It's come back down, so I'm actually back to even on it, but. I typically, when you see something pop 7 to 10% just because it gets positive mention on CNBC, I typically fade that move. But I tell you, it's holding up not bad.
Well, I mean, I wouldn't say that.
What was it? Do we know?
Who was it? No, sorry, I don't. I was not watching yesterday, and I don't know that.
All right, so we don't have the information who it was. No, I think the name was Kathy. That's all I know. So my buddy from Bright said it's Kathy somebody. I think it was ARK Investments or something, but wow, that was a big move. So we can probably.
Kathy Wood.
Is it ARK Investments? Is that who it was?
ARK Invest. Yeah.
Wow. So, anyways, mover and a shaker. That Kathy Wood from ARK Investment, because that's one of the biggest moves I've seen in Stratasys since really the earnings report, and that's what the news is, guys. It was a positive mention on CNBC Fast Money because that's when it blasted off. I know some people might not believe that they can move at 8%. They did. So it's come back in. It got up to 21.5. People got really excited last night. Maybe they were just looking for a reason to buy this, and Fast Money gave it to them. So now at a pullback, these things become interesting. Also watch DDD. I'm kind of interested in both of these. DDD is trading up just slightly here this morning, bid up, probably because the SSYS is up so much. But you know what? As trades here, as swing trades, maybe. I'm somewhat interested. Stop yourself out though, but I mean, on DDD, for instance, you could stop yourself out. Let's just stop yourself out of yesterday's low, 1093. We can get it, in the lower 11s. We'll go for a little swing trade on it, see if it gets a little love like Stratasys did. But remember, SSYS will be your leader today. If that continues to leak, then all bets are off on Triple D.
Not super heavy volume on SSYS, only about 3,000 shares that I see traded this morning. So
traded a lot last night, though. It was trading fairly heavily last night. So this move, and it's bid up here at 2060 again. Like I said, typically these moves don't hold when they just get a positive mention, but it was an analyst, so it wasn't just like a commentary that came on, obviously talked about the stock, and it really popped on her. I don't know if it was a recommendation, you can call it, or her opinion, but I can't argue with the tape from last night, up to 21.5. That was definitely overdone. Wish I would have shorted more at 21.5, but I was underwater from 2075, and I don't like adding to losers. I know a lot of, even in my day trading and swing trading, I typically don't add to losers. When I'm wrong, I'm wrong. And a lot of people do still add to losers. We had I remember one guy back on Bright Trading during the days. He'd have like 200, 300, 400 shares, and then he'd have and then it'd go against him. So he'd add another 400, then go against me, he'd add another 800, and just keep doubling down. And you know what? 95% of the time you get your money back doing that strategy. It's the 5% of the time, or maybe it's even less, the 2% of the time that the stock keeps going that direction, that you end up with an enormous loser, potentially blowing out your account. So I don't like the doubling down. That's what they do, at the casino. Some people, that's why they put limits on at the casino. And in the long run, I think you can get really hurt doing that strategy. In the short run, you will often get your money back. In the long run, you're eventually going to get one of those that doesn't come back.
All right, let's move over to the earnings here, because we had Wells Fargo come out just as this show was starting here. Same story as yesterday with Citigroup, an EPS beat and a sales miss. That's what Wells Fargo is doing this morning, or that's what they reported for the last quarter. Q4 EPS $1.21 versus $1.19. Sales $20.98 versus $21.75 billion. So a slight EPS beat and a slight sales miss for Wells Fargo. We'll start there.
Let's go check it out, because I had Wells Fargo. I actually dumped it before the report because I didn't want to take it through the report. Again, we're seeing resilience here, though. Stock got hit initially here, starting to come back. We saw this with Citigroup yesterday. It's just reading the tea leaves. And, that's how I made the call yesterday on Citigroup when it was trading down. I was like, the revenue, the numbers weren't that great. But you know what? It's not selling off, and it's trying to stabilize. So being able to read that pre-market action can make you some money sometimes. Citigroup had a great day yesterday. Wells Fargo is trying to hold on here a little bit. It's still trading in the red, so we're still, and obviously I've only looked at the tape here for about 10 seconds, so hard to really get a feel for it yet. JP Morgan, if we go to that one, it's trading down significantly. So let's do these together, because obviously these banks all tend to move together to a certain extent. Spencer, what is the
right? The JP Morgan reported a little bit of different. They appear to have missed on both EPS and sales. So their Q4 GAAP EPS was $1.98. That's either a miss or not comparable to the 2.25 estimate. And the sales 26.1 versus $27.28 billion. So about $1 billion miss, and probably a 1/4 cent miss on the EPS there. So not what you want to see from JP Morgan. They're missing on both the top and the bottom line.
Yeah, stock down significantly here in the pre-market. It is through yesterday's low, 98.66. Let's see if it can get back up and reclaim yesterday's low. If it can, then it becomes interesting. As of right now, I'd be hands off, because you get too much air below. And they don't all have to do the same thing. I mean, sometimes they just like to punish pair traders. So it's just because you get, one bank that goes, down and then rallies on its earnings report doesn't mean the next one's going to do it. They all kind of have their own mind. This one, like you said, didn't have a miss on the top. Looks like miss on the bottom, you said. I didn't look at the numbers myself, so I'm just taking your words. But, Citigroup did actually beat on the bottom line yesterday. So a little bit different story. Trading fairly heavily already, 383,000 shares have traded. I would say I can't really get excited about this until it can reclaim yesterday's low, which is 98.66. And then maybe you get a bounce play. But as of right now, I'm hands off on JP Morgan.
And the one thing I want to know, when we talk about a lot of stocks on this show, so we don't often have time to dig super deep into the reports, and I haven't done this yet, but I do want to know how these banks did in terms of trading revenue last quarter, because if they weren't able to blow it away in that quarter, or at least show some significant growth in that segment in that quarter.
Yeah, it's a good point.
I don't know what to tell you. So
it's a good point. They're not trading as much as they used to. Remember, obviously, we had the Volcker rule come in, so it's not like they're all running day trading shops anymore. A lot of them, still do some trading, but it's not like it was 10 years ago. Sure. They obviously do trading on everything, but they're not just short-term market making as much as they were before. Obviously, your major market makers now, we've talked about them before, your Citadels, your Virtue Financial, those ones definitely benefit from an increase in volatility. The banks, you can't say that anymore. 10, 15 years ago, before Volcker came in, I think you could say that. But now I think it's a little bit different. So, the big market makers who are really benefiting from increase in volatility is Virtue Financial, VIRT, and Citadel, which is obviously private. Those are your big guns. And then, there's UBS trades. Citigroup does have market making divisions. So I don't want to say they don't trade, but they're not trading. They're not your major players like they used to be. I think Citadel and Virtue, those two are your major guns now.
So, Dennis, looking at the Citigroup chart yesterday and then the Wells Fargo chart this morning, are you inclined to just hit the bid for Wells at 9:30?
I'm out. I sold Wells before. I don't want to take it through the report.
Oh no. Okay, you're out of that trade.
Yeah. I had it on.
I'm talking about a new trade.
Yeah, I forgot it on last night. I meant to sell it before. I didn't want to take it through the report. I came in late this morning here. I hadn't reported yet, so I took a small 15-cent loss just because I didn't want to hold it through the report. So, and that's just my own trading preference. I wasn't in it for trying to say, I think they're going to beat or they're going to miss. I didn't want to hold it through the report, so it was my own for getting it last night. So that's why I just sold it this morning. Sometimes when you just forget something, don't try to make something good happen and say, okay, well maybe it's going to come back or something like that. I can take a 10-cent loss or 15-cent loss before it reports. Sometimes I'll just do it. And sometimes I won't. Sometimes if I'm feeling good, I'll take it through the report. I'm not against taking stocks through the reports, but it wasn't my intentions to take it through the report last night. So that's all.
I'm just saying, they both beat on EPS, missed on sales. Both got hit initially, and Wells Fargo at least is holding up here. So would you use the Citigroup chart to inform what could happen today in Wells?
Yeah, you do. So I would be cautious shorting it because of Citigroup's move yesterday. But again, with JP Morgan down $3 here, it's not showing me the same action that Citi showed me yesterday.
Okay.
Citi was immediately showing me stabilization. And that's why, I was able to make the call yesterday. I was like, this is looking like it wants to stabilize. This looks like it doesn't want to go down on what doesn't appear to be good top line numbers. And, it's had been in rally mode. So maybe you got a few people that you can squeeze them a little bit more. Now, maybe people after the first one does that, then people start to expect it. And then they get long, JP Morgan had a rally yesterday off Citi. Wells Fargo had a rally. So you're talking a little bit different parameters here now around the trade. They rallied because of Citi yesterday. Now they come out and their numbers actually appear to be missing on the bottom line as well. So it's not as good. So things change very, very quickly. And that's what you have to be able to adjust your strategy. We have more information now because obviously we have the JP Morgan Wells Fargo numbers. And I think market speculation yesterday is they're rallying Citi on a good bottom line beat. Well, we didn't get a good bottom line beat on JP Morgan here yesterday. So I don't know if JP Morgan, I'm going to say I don't think JP Morgan goes green. Wells Fargo's trying to hold on, but obviously it's close, but I'm not playing it like I did yesterday, saying, that Citigroup's gonna, or JP Morgan's gonna turn around and go green. And Citigroup wasn't down this much. I mean, JP Morgan is trading down almost $3. Citigroup was only trading down like 60 cents. So it wasn't as bold of a call yesterday. It wasn't as hard of a call. And when it was saw stabilization, then you start to think, okay, maybe they can take this positive. JP Morgan got a long ways to go positive.
All right. Don't forget, we have Bank of America and Goldman and BlackRock tomorrow morning. We have Morgan Stanley on Thursday morning here. So far from done as far as the financials are concerned, but it is 8:14. So let's take our first break of the day and grab our first guest of the day. That is Jeff Hirsch, editor-in-chief of the Stock Traders Almanac. I believe we spoke to Jeff early in December. So let's get him on the hopper now. We'll be right back in a moment with Jeff Hirsch. All right, having a hard time locating Jeff Hirsch. I myself also had to relocate inside. I was a little bit too cold on that balcony, but we have some more earnings to discuss. Dennis, let's go to Delta Airlines, DAL. We're going to be joined by Frank Holmes of the Jets ETF on tomorrow's show. And he'll be able to break this down for us on tomorrow. But let's talk about Delta right now. They're reporting this morning Q4 EPS $1.30 versus $1.26 estimate. Sales $10.73 versus $10.76 billion. So slight sales miss. Good EPS beat for Q4. Q1 EPS guidance, a little bit light though. 70 to 90 cents was the range they gave. 95 cents was the estimate. So a little bit light on the Q1 EPS guidance, but otherwise a mixed report in the Q4 for DAL.
I mean, the airlines have been in the gutter here for about a month and a half, and Delta was one that really blasted off in October and November and then crashed in December, no pun intended. 62 down to 45 bucks, still hanging out near the lows. I said, I would say if you are looking at this, absolutely has to hold the low from the January 3rd, which was 45.08. That's the level that I would be leaning on if I was long. Takes that out, I don't want no part of it. LUV, same story. We can go to the 44 low on that. Just looking at the other ones, we've talked about how some of the airlines have been very resilient. We're getting UAL numbers tonight, so we'll have to see what happens with that. I would lean on, I wouldn't put on any trade ahead of the numbers on UAL. After the numbers, again, I'll lean on the lows of 77.39. Need to hold the recent lows on stocks because those are levels obviously are very psychological for investors here now. Nobody wants to own a stock that's making a new low. So that's the level that DAL has to hold. So if you want to put it on here this morning, that I would say that's where your out is, under 45 bucks. Can you hear me, Spencer? You're on mute. Spencer, you pulled the Joel.
Oh, I did it.
You
oh,
did.
no.
I was like, I see your lips moving, but I don't see anything coming out. So unless you're like a new,
I did the old trick. No, I was going to say, as I mentioned, Frank Holmes, the manager of the Jets ETF, will be on tomorrow's show. Can we talk about Save here? Because I feel like every time we talk about the airlines,
I just mentioned it quickly. And you know what? This was one I had in my long-term portfolio, and I sold it, and I should have rebought because I took it from. Well, actually, this was one I took some heat on. I bought it like 40, it went down to 30. Came back up to like 46, 47. I sold it. It came back down to 35. I could have rebought and had a really good trade. And then it went to 65. So it's been a wild child. Trend is your friend. Trend is up. I just say if you're looking at it though as a longer term investment here, yeah, I don't know. Are they that much better than LUV and Delta, who are all hanging out the lows near the highs? I don't like buying stocks when they're up near the highs, and the rest of the stocks in the sector aren't that good. So I'll just say I'd be cautious if I was long Save. I wouldn't want to break the uptrend. So under 55 bucks, I think I'd be out. When do they report? They coming up?
Oh, good question. Let's look it up in the pro calendar.
Bang, 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 bang. But
yeah.
Saves in there.
I've got Save unconfirmed for the first week of February. So I have February 5th. So I got February 5th. So it's not there, it'll be around there.
Here yet. Yes. Absolutely needs to hold 55. We're not going to see any of that today. I'm just telling you, swing traders are long-term investors. I'd say, well, let's go. I guess 52 was the low back from January 3rd. We'll give you the same thing. Those January 3rd lows are critical for a lot of stocks to hold.
Mm-hmm. All right, let's go into the pod sector now, Dennis, because I'm at a cannabis conference here, and the cannabis stocks are flying. Yesterday, we had some news that Canopy Growth received a license from New York State to sell hemp, or to grow and sell hemp in New York State. But we've been seeing this. I've been seeing this on my scanners here for the past few weeks. We haven't really talked too much about these stocks in the past week or so, but they've been flying, and they can't stop. Tilray, Canopy Growth, CGC, they can't stop, won't stop.
The ball gets going in one direction, and especially on these stocks, we know it can continue for a while. We saw it multiple times last year. When these things get hot, they get really hot, and they stay hot for a while. You can look at CGC back, obviously, after it got the Constellation investment, and literally, that happened somewhere, I think, around August. You can see the chart when it went from $24 up to $34 in that one day. The next day, it went to like 40. And then it just continued. And if we look from, middle of August to the end of August, early September, it got up to 56. So you're talking about a stock that went from 25 to 56, went up basically 120% in 3 weeks. So we know these things can get hot. So if you're coming in here now, you're definitely chasing. You're definitely late to the party. Can it continue? Yeah, it can continue. We don't know. I'd be a little bit nervous probably at the high from November 7th. Maybe that's where it wants to go, 46.74. But we're talking about a stock that 5 trading sessions ago was 28 bucks. Now it's 43. So you can't say you're not late to the party if you're coming in here now. And then the party ends, things can have some pretty ugly down days too. So just be cautious if you're chasing it here now. That being said, you can put anything on as long as you have an out. Give yourself an out. Don't get stuck with this thing, buying at 45 or something a day, and then it's at 40 in your face, and then you're like, well, I don't know what to do now. Now, when you start to get down with the trades, you got to get out. So that's the whole thing. That's the whole reason. And we don't talk about discipline. We do here and there, but we haven't talked about it for a while on the show. And the one reason that I've been in business and trading business for almost 20 years, it isn't that I make good calls. It isn't that, I'm, I know more than, or, I've been trading. Obviously, experience helps. But the number one reason why I stay in business is I have the discipline to get out of my losers. And that's going to be what separates you as a trader from success or failure. It's not about how much you make on your winners. It's how much you lose on your losers. And if you're sitting there, loss aversion, and you don't take losses, you will not make money in the long term in this business, because you will have trades that will blow against you. If you're one that's always taking you through 2-3% gainer, but holding on to your 10-15% loser, that math doesn't add up in the long run. Yes, a lot of these come back. Yes, in the short run, maybe I'll have an 80-90% win rate. But that 10% win rate is really bad when your losers are 10 times the size of your winners. That math adds up to a losing account. So that's the whole key, is having discipline. I always say you can put any trade on as long as you know where your out is.
And there's something to be said, Dennis. We bust your chops a lot for only talking about your losers and not your winners. But there's something to be said to devote that much mind to real estate, knowing that you saved yourself, right? Knowing that, because a winner, you book your gains and you're in, you're out, or you're on to the next one. But a loser, it could have been a whole lot worse.
It affects everything. If you've got one big losing position, great point, Spencer. If you got one big loser in your account, you're looking at this every morning, you're logging in, oh, it's not coming back, and it keeps eroding and eroding. Maybe you had a stock like GoPro, back in the day, it was $90, and it's never coming back. So get it out of your account, stop looking at it. Like there's so many that stocks don't have to come back. People think, oh, if I hold long enough, eventually it will come back. And yes, I'll tell you, 90% of the time, maybe they do. But the 10% of the time that it doesn't, that stock, that position can really do damage to your overall account. So, people, already ask me, what kind of stops do I use? It depends on my time frame. So I like typically on a swing trade to have a 3-to-1 risk reward. At least have a 2-to-1, I would say. I'm kind of maybe going a little bit too much, a 3-to-1. So if I'm looking at stock, I'm saying there's room, for this. I like the momentum. I think there's room for this to go from 57 to 60 or something like that. I'll probably give myself a point stop and, a mental stop. I don't like to put them physically out there, but I'm sitting here, all day, so I can kind of monitor it. So, that's in swing trading. And day trading, in my scalping, I try to limit the losses as much as I can. I almost want immediate gratification in a lot of trades. Like sometimes I'll let things go against me, like SSYS, I let it go against me a little bit there last night because I just thought it was silly. The thing got up to 21.5. I'm like, there's a lot of people buying this thing right now. It shouldn't, unless there's some news that I'm missing here, I think it's going to come back in, and it did. I should have probably added to the loser and went against my own rules, but I don't like adding to losers. So anyways, and I'm sitting up here this morning up 30 cents in it now. So I was just feeling good about that one, but typically I don't like letting things go against me. My day trading stuff, like when I'm putting trades on at the open, I typically want immediate gratification. I want them going my way. If they're not going my way, I'm getting out of them immediately. Sometimes I'm getting out of them for a nickel loss, a dime loss, because I've went in saying that I think the stock's going to open too low or too high. If it opens low and goes lower, that means I was wrong. And I got to admit I'm wrong right away and get the hell out. So all about protecting the capital as much as you can. A lot of stuff I'm doing, we know I do a lot of statistical arbitrage, so I want immediate gratification on those trades too. I do risk arb. I'm trading Celgene versus Bristol Myers. I was trading it last night again. It's still a little bit fluffy because it's early in the relationship, but it's starting to stabilize to a certain extent. Bristol Myers falls, Celgene's going to fall. Bristol Myers rallies, Celgene's going to rally because it's getting taken over. So a lot of, trading that I do is relationship-based trading. That's my day trading. So usually those, work out a little bit more than they don't. And if they're not working out, there's a reason for it. So I typically don't give those much room at all. I'll typically get out very, very quickly when I'm wrong. But the swing trading, I give it a little bit. The investing, I try to really give it a lot because it's long-term investing. It's different. You could use the same reasons, you can use the same theories. I try not to look at my retirement account and do different things. My whole theory is that, the market's going to be, when I retire in 20 years or whenever I retire, that the market's going to be higher than it is now. So all my ETFs and stuff that I own, I never sell those. I buy them and never sell them.
All right. I want to introduce Jeff Hirsch right now from the Stock Traders Almanac. Jeff, do you have any opinions on what Dennis was just saying there, or no?
Can we hear Jeff? I can't hear him.
Jeff, I think
Can you hear me now?
Yes, we can.
I had muted it while you guys were talking.
Oh, that's the Joel Elconin trick. He does that once a show. He's been doing the show for 4.5 years, and Joel still does it every show.
Better than hearing me snore while I'm listening.
How's it going?
I was putting you to sleep. Oh no, I was putting you to sleep. Okay, well, excite us here, Jeff. Give us some good stuff.
I meant just my breathing, my winter stuffiness.
Jeff, what's going on? We got to talk some seasonality, and I just want to maybe.
I do have an opinion on stops.
Yeah. Talk to me about that. Sure.
Well, it's relative, I mean, bigger caps we give more room on the downside. Smaller caps we give greater room. We have different strategies like our free lunch strategy, which did pretty well this year, picking new lows, stocks making new 52-week lows on the triple witching Friday of December. Of course, we had a nice big correction that helped us out there. We're in the midst of that. That we had an 8% stop on. Our talking about seasonality, our best 6 months switching strategy, and the best 8 months NASDAQ. We don't have a stop. That's a seasonal trade. I know it's kind of like a swing trade as you were talking about there before, but if we had a stop on that, we would have gotten whipsawed out at the Christmas low. So it depends upon the trade and the purpose. Just like going into anything, you got to have an exit strategy, knowing what your purpose is for the trade.
Yeah, I completely agree with that. So talk about some of the seasonality trades here, because we could just even go, back to the one that just went by. Obviously, we had the Santa Claus rally, and it was a pretty good one. Talk about, what that is, for people who don't know what Santa Claus rally is, and talk about the setup into it.
It's not really a trade. It's an indicator. Yes, there's
I use it for a trade.
Well, and you should.
An indicator to get me into a trade. That's yours, Jeff. I'm using your strategies.
It's not a strategy, though. It's an indicator. But there is something to be said. I mean, our free lunch menu is there to capture that Santa Claus rally as well. But the actual Santa Claus rally is an indicator. The line my father came up with: if Santa Claus should fail to call, bears may come to Broaden Wall. When that generally bullish period doesn't exist, it's a negative indication, or an indication that people aren't really enamored by the market. It's only the last 7 days of the last 5 days of the year, plus the first 2 of the new year on the S&P. It does benefit from the small cap effect, what people call the January effect, which really starts the last 2 weeks of December. So yes, I'm glad you made some money on it, and it's good that you did, that you were buying then, because had you not been, it would have been an indication that the market wasn't really strong enough. And we've seen, on top of the Santa Claus rally, we have the second leg of our January indicator trifecta bullish, the first 5 days. So we've got some good strength at the beginning of the year. Not too hard to fathom after the shellacking we got in December and November and October, which was one of the bullish quarters, of the most bullish quarters of the 4-year cycle, which is a big negative. So if we can overcome that, that's pretty positive. If we get a positive January barometer, full month S&P January barometer positive, then we've got a trifecta, which has a 90% chance at the last 30. It was 27 up, 3 down for the year being up. Last year was wrong. We had a positive trifecta in 2018, and we got, it taken apart at the last quarter. So while there's some positive bullish seasonality going on here and some good technical trading, we're also bumping up into resistance. I don't know if you saw my little post I put up yesterday. We're hitting that. There's some levels there near the February lows of 2018. Also that gap for the S&P and Dow back in the end of November 2017, before we skyrocketed to that 2 standard deviations above the range in January 2018. And we've also got some fundamentals that are starting to look a little bit shaky. So just to underscore that seasonality is not the only thing that you need to look at, even though you had a nice trade there with Santa.
One tool in your toolbox.
Exactly. I mean, our market at a glance is 5 disciplines. It's seasonals, psychology, which did get more positive. We had, I look at Investors Intelligence, bullish advisors on top of put call and some of the other surveys. It flipped to the most bears since 2016, the February 2016 lows. So, there's cross currents there, which makes good opportunities for traders, day traders and swing traders like yourselves, if you're playing momentum and using some of that stuff. So we've got some work to do here before we can be out of the woods of this correction, even though I don't love using that word correction, this sell-off bear market. We're right here at the bottom of those, what was support there at the February lows that we broke through. It was looking like a swing bottom, a W123 swing bottom there in the fall, and we broke through the floor of that. Yeah. And now we're trying to form another, support there.
What's your gut saying here? Because I look at this, S&P chart and I say, and it's similar to what you were saying, you're coming back up near major resistance. We're stalling out here a little bit. We've had a significant rally from 2 weeks ago. I mean, there's people coming in here now saying, I got to buy now because, everything is cheap. But I mean, stocks aren't as cheap as they were 2 weeks ago. We've had a pretty good rally here. We've got over half the losses back. You're buying somebody else's profits here right now. Are you late to the party if you're buying here now?
Short term, I think so. I think we're looking at the potential for the January break materializing here, after mid-month. But I think longer term for 2019, that correction, that reset, set up a potentially, more typical pre-election year trade. But it depends on what goes on, in Washington. This whole shutdown thing, the market's run up through it. Maybe we're liking that the government's not doing anything. I don't know. There comes a point where it becomes more of a detriment. Right now, they're just frozen, and you got gridlock, which Wall Street kind of likes at some level, as long as they're not bickering. But if we don't get something positive out of Washington, that's going to be a downdraft on the market. So we're going to need some help from some overseas things as well with Brexit, and also going to need some help from DC, from these people. And look what happened in the years, the Reagan, Tip O'Neill years and the Clinton Gingrich years. You had opposing parties, putting their attitudes or their hubris, at the door for a little bit and compromising on some things. That would help.
All right, we've been on the line with Jeff Hirsch from the Stock Traders Almanac, the master of seasonality, but it's only one tool in his toolbox. Jeff, as always, thanks for the time, and we'll talk to you later in the year.
My pleasure, gentlemen. Have a great day.
All right. Jeff. All right, it is 8:36, so Nick Chahine is here already. Nick, you beat me to the punch. How's it going?
Good. I live to find the Skype answer button. They keep moving it on me. I hear it ringing. Where the heck is the freaking button? It's just unbelievable program. Okay.
I can't find that button sometimes too. I'm like scrambling around. You know what? In the new Skype, it'll move it on you. You look at the main one, but then you've got another little one in the corner. And it's like, then I can't. And Joel can never find the unmute button. Like Joel mutes himself every show. Never find. We'll pick on him a little bit because he's not here. He's probably listening. He's going to text us in or call in here and say, I don't do it every show, but he does it every other show. the old mute trick. And Spencer did it this morning too. But Nick Chahine, what is going on?
What is going on? Just range, trading the range, basically, holding on to the longer term bets and having some hedges in the short term.
Okay, this is a good one. So you've got some longer term bets here right now. We've had a pretty significant rally, so those have probably paid you pretty well. When would you, at what point in time would you say, okay, it's time to ring the register on some of these long-term bets if the market doesn't look as healthy as it did? I mean, if it continues going up, obviously you're going to continue to hold, but do you have like a stop in mind? We've been talking a lot about stops on the show here, and you look at the S&P, we've had 3 or 4 days really of consolidation here. We're struggling a little bit at the December low and the October low. They're around like the 259, 260 on the SPY. When would Europe be like to raise or to maybe lock in some of these gains that you've just made?
I'll give you a perfect example. You guys just talked about CGC canopy growth. I was long it. I was long it, and I had like I can't remember, 200, 300% win. I booked it a day before yesterday, so I think it was.
And
Friday.
Is that just because it's moved so far for you now? You're like,
because I had a 300% win. So
yeah. Well, but that's a great. I mean, 300, but it's on options too. So, obviously, when a win for me, as just me and Nick are maybe at the other end of the spectrums here, because I enter a trade, when I'm doing stat arb for like a 0.05%. So 5/100ths of a percent is, a win for me. Because I'm basically a scalper, on some of these strategies there. 0.1% is good. Sometimes in a really good market, you can get 0.2%. Those are good trades. You're holding on things longer. You're in options, so you make 300% on one thing, but sometimes you lose more than you're going to lose more than 300%, obviously. Right. But what's your stops look like in these types of strategies?
So on the upside, the stock had moved X%, and it was way too big for the period of time I was watching it. So I knew that technically I was entering a level that could become resistance. So all of these come into play. A, how much it's moved in my favor, for example, in this case, and is there more technical upside? So I need tiebreakers. And in this case, the tiebreaker wasn't there for me to hold it an extra day, although I would have made a lot more money. But I'm not broken up about it. Because like you said, you're in the game long term because you make the right decisions, whether they're perfect or not. In fact, they're almost never perfect, hindsight. Never. But they are to be done every time. So next time I come, I don't say, oh, last time I did this to CGC, it bit me because there was extra upside I left on the table. I will probably make the same decision again. So on the upside, I have to look at the technicals. And at the technicals, I thought that 40, 41 was going to be a difficult area, potentially difficult area. Well, they continued on higher. But I didn't look back every 5 minutes and say, dang it, how much did I miss out? And I didn't calculate how much I missed out.
What about when they're going against you? I mean, sometimes you have trades that options move against you. Where are you looking to, cut your loss and say I was wrong?
Okay, so it all depends on the thesis. I'll give you an example. I was long Micron by selling the $31 put. It fell into that. And this is where you decide, okay, clearly price is going against me, but the reason I entered it was value, and it was still there. And the rhetoric was causing it to fall. And I don't buy into the bullcrap rhetoric that because they do it every time. At 60, everybody loved it. At 30, everybody's selling it and saying it's going to go lower because of NAND price or whatever. So I disagreed with the rhetoric. I had value on my side. I was willing to be put to stock, and I'm out of trouble now. So,
but that's a winner. I'm talking about your loser.
Well, it wasn't a winner. It wasn't a winner. It was a loser.
But you held on to it. So do you stop out on your losers? Like when you get down a trade, do you have stops?
I do.
That's what I'm asking is talk about not something that's come back, but talk about something that doesn't come back. Like, how do you know if Micron would have went to $25, would you have cut it out and say I was wrong? Or would you have just kept holding on?
I would have owned the stock long term. Because
so you're holding on to that one.
Because of my thesis. So it doesn't apply to your question. If it was a trading strategy like you were asking and it goes against you. So I was long a Apple, a VI credit put spread in the middle of 50s, 157. And then it took a dump because of what they said. And so I was like, you know what? I'm going to cut my losses because I don't believe in it anymore, the trade. The levels are broken. I'll take my first loss and I'll move on. So if I wanted to own Apple later lower, it would be fine. And indeed, I did sell naked puts into it and came back whole, but that's how I managed my loss out of it. But the standalone trade was broken in my mind. And in fact, that's the only mega cap I probably wouldn't bet on long term. So that's aside, because I don't like what's coming out of Tim Cook's mouth. And so when a CEO says, we've never been better, when everybody's questioning everything they're doing, he's either got a heavy home run in his pocket or he's full of it. So, but you have to put a level of stop. But beforehand, it all starts with the thesis. Why did you get into it?
Oh, yeah.
Right? If you don't know that, then how can you know that you're still right or wrong? So make sure to know why you entered it. I entered it because I thought that it had enough buyers of what I'm hearing about it. So I was like, you know what, I can risk my money below here because it seems to have rhetoric support and the technicals were okay at the time. And then those broke. And then the rhetoric went negative. And I was like, okay, so I've got nothing. What am I hanging on to? Hope? That's not right.
So when your thesis changes or your original reason for entering the trade is gone, that's when you would get out?
Yeah, in that case, it was because, I didn't have the technicals on my side. I was just trading the environment, and it went against me. I was like, I'm out. So it all depends why you entered, what was your trigger, and if it's still there. Another one, I shorted bonds a couple of days ago, and so it went red a little bit yesterday, and I was like, you know what? The reason I entered it is still there. It's kind of a binary thing, so I held on to it. It wasn't really red, and then suddenly it went up 20%. So now I'm sitting on it, and today I will decide whether I will get out or not.
Let's jump over just to your market thoughts here, and let's just ticker time. If you guys want to throw some tickers in the chat for Nick, will do. I'll start it off here, and I want to talk Netflix with you because this has had an incredible run. We were looking at a stock here 3 weeks ago at $230, and everybody had in the gutter. It is now $337. It's rallied 105 points here in 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 trading sessions. That's an incredible run here for Netflix. What are your thoughts here as we trade 336 this morning?
Netflix popped out an alert on my screen, and I shared it in the chat room at 270.6. And I said, this is a long one. The target should be about 290-ish. And then last week I said, if they have their way at 322, 323, it could be 380. But there are stops in between. Like there are levels to look at right above the high that we just had in like the 340 area. There's another level at 350. I'm just using round numbers. Those are not the exact lines. Another level at 362, 363, and obviously the last fail level, which was the poke off the earnings, which was what, 370 something, almost 80. So in a perfect world, it'll go there. It is a momentum stock, so if the market in general hiccups, which it could in the next day or two, then it will revert lower. But then you start looking at the necklines from which it broke out. So first will be the 320-ish, next will be the 300-ish, and then 280 and whatever 270. So every neckline becomes a potential support area on the way down.
Jump over UNH, they're asking about in the chat. It did have earnings this morning. I'm going to throw it to Spencer Israel first to give us the earnings numbers. Then we'll tell you the pre-market action. Then Nick will give you his thoughts on it. So Spencer, what's the numbers for UNH?
Yeah, we talked about them earlier in the show.
Did we mention them?
Yeah, I believe we did. But
I don't remember doing UNH.
Okay, do it again in any case.
I think we might have been the pre-market show. I don't know if we did on the regular show.
Maybe you're right. Q4 EPS 328 versus 321 cent estimate. Revenue 58.4 versus $57.99 billion. So a beat on the EPS, a beat on the sales for UNH. You're right. We did not do that earlier.
So UNH is trading down 5 points here in the pre-market, giving back a little bit. 243 is where it's at right now here. Yeah. Nick, your thoughts here technically as this thing trades down this morning?
So I see two zones, one resistive, which is let's call it 250, one supportive, let's call it 240, 239, and it's right in between those. There are probably more, this is the daily zone as far as more minutia. If somebody is really a fast trader, then you can look at the 241.75 probably is a significant level, and 243.30. So I would expect some support there unless there's more to the headline that I'm reading. I don't know what the headline says, but below that 236 comes into play. Above that, a trigger would be, I would chase a 249.80 plus close, say on a 4-hour chart or something like that. So maybe there's nothing to be done in between those lines, but if the breach of either side, usually when something trades inside of a range, a breach of either side should be followed in that direction. It seems like a decent company. I don't know what they had as far as news.
All right, Nick, got some questions for you in the YouTube chat. Can you take a look at Adobe for us?
Yeah, great company. They have the mailbox money, I call it, recurring revenues. So if the markets are higher, Adobe most definitely will be higher. It has a gap to 2 45 and change to fill. So on a daily, a break above, oddly enough, the point of control eyeball is somewhere around 240, 239 and change. So a close above that on the daily is pretty bullish in my opinion. So it will need the general market. So everything I say here will have to fall inside the macro. So what is the S&P doing? So maybe we move a little bit higher, but I said to my peeps that we may not have divorced ourselves from the February lows. But even if we do dip, it's a buying opportunity. So that's my thesis, to give you an idea of what I expect. So inside that thesis, Adobe would be one I would hold. But if for a trading vehicle, I would need a close above the last failure point, which is about, let's call it just under 240 on the daily. Then I would own calls. And if I buy calls, it'll be longer dated so I can withstand a couple of bad days like I did with CRM.
AMD getting a pop right now. Just people talking about it in the chat, and I do see it popping on my screen. The EE Times article this morning that Intel, and I wouldn't put any weight in this at all, but they're saying that Intel is sniffing around and pondering the acquisition of AMD. But if you read the actual article here, I'll just give you the first two lines reading right from it. It says, during the Consumer Electronics Show in Las Vegas last week, we picked up an intriguing rumor circulating among a few C-level executives that Intel is pondering the acquisition of AMD. Given Intel's history versus AMD in the CPU market, common sense says that is unlikely marriage. Most analysts we reached dismissed it outright. So they put out an article, they won't put out a headline out there, and now they say in the second line of it that this probably isn't going to happen though. Yeah. So I don't see the point of this article at all, but that's why AMD is trading up 1.5% right now, because I see it going off in Twitter that, Intel sniffing around, but I would give this zero weight. I don't think this is going to happen.
Whether you give it zero weight or not, it could trigger a inverse head and shoulder-ish pattern. So there is one funky candle.
The chart looks okay. Yeah.
That's my least favorite of all of them because it's the most expensive of all of them. Even NVIDIA.
Talk about this.
Well, even NVIDIA was under 20 PE, and I don't believe AMD still makes a profit. So why would I chase the frothiest one of them, even though it held up the most? Was it like 50% last year and everybody was down?
Because it had such a good year.
So I'd rather bet my money on NVIDIA. If AMD is rallying, NVIDIA should rally too. I did bet on NVIDIA and I won, and hopefully people that bet with me stayed in it. But of course, I booked my profits early.
You got that scalper blood like I do. You got to hold on better, Nick.
Yeah. Ooh, green. So inverse head and shoulder, it's not perfectly drawn, but there is a neckline where it's going to invite buyers. So be careful shorting it, but it wouldn't be the one I would chase. But if I saw the technical opportunity, I would definitely take it. So, headline or not, substance or not, it will be market dependent, although it wasn't last year. It was inverse market. Basically, it performed without the market, I should say. So, technically, it looks okay.
What about Intel? And this is an interesting chart here because this actually held up, I would say, much better during the recent tech wreck in December. Intel was down, but it wasn't down nearly as much as some of the others. And maybe it's because it's got a lower PE, lower beta, but it's right up here and it's holding up fairly well. What are your thoughts on Intel for, going forward? And what do you think of the chart here?
Technically, same setup, although not perfect, but it's the same setup where you have, they're having ascending prices knocking on necklines. And when the necklines break, it's not a perfect head and shoulder cup and handle or inverse head and shoulders, but a neckline is being attacked. And in this case, it's 49.50. If they can get over it, then they might spur some momentum buying. So if you zoom out to a daily chart, you will see the upside potential. There was a gap that would probably take it to 52 eyeball. Along the way, there was a big failure at 50.5, that one funky island poke, whatever you want to call it, above 49.58, and then immediately reverted lower on the daily. Now I'm talking. I can share in a second. So there is potential upside, and you can put an alert. And usually I don't like to anticipate. I do sometimes, and I pay the price once in a while. But if you see a break above a neckline in a direction, usually it has legs. So in this case, it has reasons to go higher, and it's not that expensive. I don't think. I haven't checked the PE recently. Just the traditional way. It's not like a foolproof method, but it gives you a gauge of what's valuable, what's not. If you have some sort of a handle on the actual, so it's an 11 PE, and that's a trailing PE. So I'm not saying based on forecast. This is actual 12 months price to earnings ratio.
Yeah, it struggled here up at this 49 spinner, making that point multiple times. It's where it got up to a couple days ago again. So for
but that's why you wait for the break.
Yeah, and earnings are coming.
The last failed level. Yeah. So earnings makes it more of a lottery ticket. So two ways you can approach the earnings: buy just before the earnings, hoping they'd run into the earnings. That's the cheapest way, but the shortest time frame, obviously, and or buy a level way out in time that you would actually hold, earnings or not, and then you'd be able to swallow a move into earnings that goes against you for a little bit. In other words, gives you time to manage your loss if you want to.
Couple other ones coming from the chat. I'll let you go next there, Spencer. Sorry to monopolize the conversation here.
One more.
ABGO, Griffin.
ABGO, what? Avago. Okay.
Yeah, Broadcom. Sorry.
Yeah. AVGO. All right. So talk about ranges, right? Even on the daily, this guy has been ping-ponging violently inside of a range. So trade the range until it breaks out. Same comment as before. If you're a trader, you just know not to chase at the edges. This is where you get out. And there's a range inside of a range. So 232, these are big numbers, but I'm looking, to 255, but the bigger range extends way lower. So if you're confident in it, you can sell put spreads at levels where it has support, and it depends on your time frame. Then you choose a level. So you have to get up to close to 230 if you're short term. You can go way out to 210 lower if you're a long term better on it. And above 258, it could have more upside. Shorter term, above 253, it could have more upside. So it all depends on your time frame. So there are tons of areas you can chase.
Nick Chahine is the author of Create Income with Option Spreads and sellspreads.com. Nick, we'll talk to you next week.
Can't wait for it. Good show.
All right, have a good one. All right, Dennis, 5 minutes left in today's show. Let's talk about Play, Dave and Buster's.
Yeah.
They came out with some guidance yesterday after the bell. They raised their fiscal year 18 sales guidance from 1.24 billion to 1.25 billion on the low end of the range. The fiscal year net income guidance was also raised by $6 million, 106 to 112 million on the low end of the range there. So guidance raises for net income and sales for Dave & Buster's.
One of the best ticker symbols. Love the ticker symbol PLAY. Stock, I don't love as much as the ticker symbol here, just because I think you're going to run into trouble at 55. So you're at 54 here in the pre-market now. Again, it's the same story. You're late to the party here. Maybe some of these parties are going to continue to go, but you are running into a major old support, which was 55 back in October. We broke down in December from there. I think you get back up to 55. I think you have some willing sellers. So I think you got like 1 point upside left here, really, in my opinion. Maybe it continues to go. Anything can happen, but I'd want to see it, break through the 55. You can give it a little wiggle room, maybe up to 55, 52 if you're playing it from the short side. But I think I'm more inclined to short at 55 than buy it. But it's hard to short the rocket ships too, and the stock's been straight up for a while, and now it's going to be up here again this morning. So I'm probably just sitting on the sidelines on this one. But if I was long, I'd probably be ringing the register at 55.
All right, let's get to some of the ratings from this morning. There were a lot, but not a ton that are moving stocks. We have Morgan Stanley upgrading Akamai Technologies, AKAM, to overweight, and DocuSign, DOCU, to overweight as well. Actually, while we're at it, and Tenable Holdings, TENB, to overweight as well. That's all from Morgan Stanley. So Akamai,
busy.
Akamai is moving. Last I looked, and
AKAM trading up about $1.50 on the upgrade. 65. You got some levels here. Again, we're running into a lot of these charts look the same, and maybe that's because when the market starts, the VIX starts to go higher, everything starts to become correlated. Start looking at charts, and they all kind of look the same. So I'd say, first resistance point 65 on Akamai. Let's go DOCU. that chart looks completely different than the other ones. If it could get above 45, that would be in breakout mode. That's going to be your test, though, and that's where the major resistance has been back to November. Above 45, the stock is interesting. So I don't know if it's going to be the catalyst to kickstart you up there, but I'm more inclined to buy this one than Akamai here because this one's actually formed a nice base. The chart is looking like it's itching to kind of go above 45 would be in breakout mode. So keep an eye on that one for potential breakout.
Morgan Stanley is all over the market today. They're also downgrading Oracle to equal weight. They're downgrading Zscaler to underweight. They're downgrading Nuance equal weight, Atlassian ticker team to underweight, VMware to equal weight, Yext to underweight. So they are
slow down, Morgan Stanley. Slow down. I can't even handle all these.
All right,
Morgan Stanley is busy and they move. I mean, Morgan Stanley is one of the most influential, obviously, analysts out there. So when they're giving an opinion, people will listen. So some big moves in some of these stocks this morning. Let's go to VMware. It's had the nice run up. 130 up to 150. The trend there, though, you're kind of almost at a point where you got the bulls and the bears meeting up here. A little more bears winning on this one than some of the other stocks. It's kind of starting to break down. I don't know if this downgrade's going to take it down, but there's a lot of air below, at least air to 140. So we'll see. Buy the dip mentality is still in this market. So I don't know if I'm shorting when it's down $1 here. But there is some air below on this one. So it's had a nice run, although it's off the highs from a week and a half ago when this got up to 151. You're looking at it almost down 10 points from those highs now. So it's not like selling at the top either.
All right. That is going to do it for our show today. It is just about 9 o'clock here on the East Coast. Thanks to everyone for listening. Thanks to our guests, Jeff Hirsch and Nick Chahine. If you missed any part of our show, catch our podcast. We're on iTunes, SoundCloud, Stitcher, TuneIn, and Google Play. And of course, you can always rewatch us on YouTube. Please remember, all the information from our show is for informational purposes only and not meant to be investing advice. On tomorrow's show, you'll be joined by Frank Holmes, as I mentioned earlier, and potentially Gordon Johnson. Still waiting for confirmation on that. I will not be with you, but Joel will be. I'll be out now until Friday, but Joel will be with you tomorrow through the rest of the week and going forward. He'll be back from his trip. So you'll be stuck with Joel.
It's been a long trip for
tomorrow.
Joel.
Yeah, he's had a crazy few weeks. He's been out and he's missed a lot.
Oh, this guy's just living it up too. I'm the only one that doesn't go anywhere. I'm here every day.
You just went to Disney World. Actually, yesterday.
Disney World was a year ago. You know what though? Yeah. I don't go anywhere. I just stay.
Wait, Dennis, I was in Disney World yesterday for about a half hour, and then
what are you doing at Disney World? You do everything. You did Disney World yesterday. Just passing. Passing. Oh yeah, I was at the.
I did it so fast. I did the whole thing in a half hour. No, I had to drop off someone in Orlando, so I drove up to Orlando and then flew back down to Miami. But so I've been all over the place as well. But I'll be back on Friday. Joel will be back tomorrow. In the meantime, folks, have a good day, and have a good day.